Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'm going to be your host here for about the next 25 minutes here, and maybe 20 minutes. It's going to be a short and sweet version of Options Guide TV. We're going to look at one trade. I actually have a position on today in IWM, and I'm going to talk about that trade. And I'm going to just look at IWM in general. I think it's at a precipice. We're getting so much economic data. The marketplace has taken it as a positive, but there are signs that the economy is slowing. The Fed has changed their outlook as to how many cuts they're anticipating going into the end of the year. We had still strong jobs growth, but we saw CPI come down a little bit. The numbers are going in the right direction as far as inflation is concerned. Marketplace has taken that as a positive. We hit all-time highs in the SPX, in the NASDAQ. IWM is still trying to figure things out. We broke to an upper channel, and we're still now trading in a smaller channel, smaller range in IWM. And so we still very interest rate sensitive, but also when we talk about IWM, that's the Russell 2000 index, ETF that tracks the Russell 2000 index. And it's just kind of, it's a real interesting dynamic in that lower interest rates definitely help small cap companies. Obviously, the cost of capital is a big deal when you're trying to deal with new companies or smaller companies that are trying to grow. And then on the other side, though, they're also very susceptible to a downturn in the economy. So when you start seeing some slowdown in GDP and just the economy in general, which is helpful for inflation, but not necessarily helpful for small cap companies. So the ideal situation is that you have lower interest rates and the growth in the economy is still strong. That's the ideal situation for the Russell 2000 index. And because we're not getting that, you're not getting both scenarios to play out, which is obviously a Goldilocks situation. You're seeing the IWM just really battle, trying to decide where it wants to go to next. So I'm going to do a trade based off of that information today. I'm going to do one that's going to be short term and that gives us something to talk about next week. I have this trade on inside my portfolio, so I'm going to talk about it. I'm going to look at it and I'll send some updates. I can X them out or tweet them out. I don't know what the right vernacular is to use in this day and age. X.com, formerly known as Twitter. And we'll look at that trade. And then I want to look at a little bit longer trade in IWM. IWM, we've done a couple of long straddles and all of them have panned out. So I kind of think that we're at that range once again, that we could even talk about a long straddle. Now, I don't have a long straddle on in my own account, but I do think that there is some potential for that trade based off of where we're looking at IWM on the chart. So let's start by going to the TradeHawk software. And by the way, if you have any questions, please feel free to put them in the chat box. If you're in the Tradier hub, you actually have to log into the hub to be able to ask questions. But if you're on the YouTube platform for Tradier, you can ask questions via the chat box on YouTube. We're also streamed live through X.com. There's no opportunity to ask questions there, but it's a very simple process. If you follow me at Brian Overby, very, very easy username. At Brian Overby is my Twitter handle or X.com handle. All right, here we go. So right now we're seeing the TradeHawk software. We're going to pull up the chart, and I have a support line. I'm going all the way back. This is an 800-day chart. This is going all the way back to 2022. And we see this was a very defined channel. We bought, I think right down here, we actually bought a long straddle, wondering if the market's going to go lower. And we came back and bounced all the way back within the channel, even had a huge gap up right in this range here. And then we also bought a long straddle right here, anticipating that the market has broken out and maybe going to the upside. So on this end, the calls kind of worked out. It was a shorter term long straddle. And then we came back within the range once again. And then eventually we had to break out. And this was really disappointing to see that and sometimes when the IWM and the Russell 2000, it doesn't always play nice as far as charting is concerned. You just have, I mean, you have companies that can go bankrupt in the Russell 2000 index because they're talking about small caps. So usually they try not to pick ones that are in that precarious situation. But so we came back down, hit this, came down to even below that gap, did a little bounce back up, and now look at where we're at. So the fact that we broke through this support, came back, went all the way back up, set a recent high right around 210, and now we're right back to this level again, all the way across. And this is going years out that channel has been defined. If we even go in and we look at, let's go like 1500 days or so, you see that you had that kind of defined channel going all the way back to 2020. Strong move to the upside, comes back down, but man, look at how good that defined channel is. And once again, we're sitting right on that precipice. And so on a short-term basis, and let's zoom out just a second, I'm going to bring up the options playbook and we'll look at that. There we go. So let me bring up the playbook. And the trade that I'm going to look at today, and this is a trade that I just have on. I want to place this trade. And like I said, I'm going to look at a long straddle too, and take a peek at that. But let's now go to the options playbook. Let me actually pull this or zoom this in a little bit here. There we go. See it a little bit better. Okay, so we're made some changes in the playbook in the website. Here's my website, the options playbook. We actually have a search bar that will let you search for specific option strategies. And then also we just have all the strategies under one tab now. So it's much easier to find the strategy that you're looking for. You can always, if you're just perusing, you can always just go to resources and click on option strategies. But this chart, and I stopped it right there, we actually have the graphic kind of showing right now that we're starting from 24 days to expiration and we're moving on out. So we're going to, the market's going to be right about here. This is where the IWM is going to be on our strategy. And we're only going to go a couple of points, and we'll go back and look at that chart and zoom in a little bit more. But what we're looking for is if we do break down back into the channel, can we get another nice strong move in the short term to the downside in IWM? Because once again, you got this, the market's anticipating that there's going to be a rate cut, but at this point in time, there's a potential now that they don't do a rate cut at all. And the economy is actually weakening, and where they're finally getting some of that data, and the market has actually taken that as a positive because they're anticipating the rate. I just think we're really at a point in the small caps where something has to give, where we're going to get a little bit of movement in it. And this gives you that strategy where if the market does go up, no harm done. We'll be doing it for a small credit, maybe even. We're going to be very close. We're only going to go out a few days in time, and we're going to see if we get that move to the downside, and then that's a win-win. We'll have a fairly low requirement on our 1x2 trade that we put on. But what we're doing is we're selling one put and then we're buying two puts. We're basically selling an at-the-money put option, bringing in all that juice and using it to buy two out-of-the-money put options. The whole goal is to sell enough premium on that at-the-money option contract to buy the two out-of-the-money option contracts. And that's, if I can't get that done on my back spread for even or a small net credit, then I think it defeats the point to do the trade. If you do see a lot of volatility, you don't mind paying a little bit of a debit on the trade, but this is the way that I'm going to approach it in our very short-term trade here. Okay, so Other strategies, if we look at the long straddle too, which I'm not a big long straddle fan. Very rarely do I see opportunities where oh, that's the strangle. So I also think that if you go longer term, the Russell 2000 index is going to figure it out. They're going to kind of define what they're looking to do as far as the marketplace is concerned, kind of defining what you're looking for the marketplace to do. So once again, we have the graphics. I'm going to pause it right when we start right here. And so to start with, we're going to go out further in time and we're going to buy a long straddle. That means we're going to buy an at the money call and buy an at the money put. As the market goes by, eventually you get down to this trough, but we're not going to be in long enough to hang in this range. To start with, the profit and loss graph looks really good. If you can get the movement right away in one direction, that's a good thing. Over time, though, eventually you start getting into the valley of death on the trade. So here is about halfway through on the expiration. We started at day 24. We're now probably at day 12, approximately on the graph. This is when I would get out of the trade. If the market is just hanging right at our middle strike, right at our strike for our put and our call, we're just going to want to close that trade out because we don't want to be in the last week of trading, get that boom, my sled hit the tree and go all the way down to zero. So if we're not getting that movement in a couple of weeks time, we're going to just close out the trade on the long straddle. So now let's zoom back out and let's look at these two trades and look at these setups here. So 1 second. Get back into the Trade Hawk software. And in the short term, now I want to talk a little bit about the setup of the ratio put spread to the downside. And we're going to look at two trades just to just show you what's going on with those two trades. Okay. So we're going to come all the way back to here. This is the trade that I'd set up before we kicked off Options Guide TV. The market, once again, is just hanging right here at 198.77. It's been down about three. It's been just been staying right within the range. Once again, looking to see if it can break out to the downside or bounce and go back up in that scenario. Market's at 198.75, so it hasn't changed too much. Now, small net credit, 2 cents to the account. I don't mind. I don't mind that at all. We're selling the 199 strike put. Now, this is the most at the money's put. We're bringing in $1.40. We're going down 2 points. That means we got 2 points of risk on our trade. This is our trough right down in that range. And we are going to use this credit. Notice 149, 72 cents. If we just look at bid to bid on this scenario, that obviously pays for two of these. So very like we're even right at even. We're at 1 cent net credit to the account right now. So if we do this trade, we need to think that the marketplace can move at least $4 by the June 4th expiration, which is only 4 days away. So that is a very potential, that's obviously a very possible move in IWM, especially considering where we're at. We need that either break down or need it to bounce and move up. But if it just moves up and it goes up a point or two, oh well, we made our 2 cents. That we basically got out with no risk whatsoever, didn't have a loss on the trade, and there's really no worries. We're going to go over the weekend. We'd really like to see something happen on Monday would be ideal, where we get to move to the downside. But if not, we're probably going to get out Monday or Tuesday if it's still hanging right around the 198 or well actually 197 range if we were to just kind of drift down to that range. So if we look at the what if calculator, and I think I've already sent it there. Yeah, this is where these 199, yep, that's the right one. So in this scenario, to start with, you see, let me pull it down and let me zoom in. Let's grab this and go this way. Okay. So to start with, when you first put on these trades, there's just not a lot of risk at all, especially if you get them done for a net credit to the account, because on the way up, you see options would expire worthless. Both the puts and the long one and the short one would expire worthless. And you basically just break even. On the way down to start with, like I say, by Monday, we're looking pretty good. If we can get the market down to 197, we're still doing okay on the trade. We'd be up, it looks like here, uh, about $28 we'd be up. Now I'm looking, my eyes are going to the left side of the chart over here. This is where it shows you your profit and loss. So even if we go down to our strike where all of our risk is at on this trade at expiration, we're still okay on Monday. Now, if we fast forward in time and let's go to Tuesday, now we're a little scared about the trade, right? The maximum we can lose on the trade is the $2, and that would be if we hung all the way to expiration. But if it comes down, there's a lot of difference between the movement to the downside now and the movement to the downside on Tuesday before that Wednesday expiration. So Monday would be ideal if we get to move. Let's actually kick it back to Monday, which would be the 17th. This is about where we're at. If we just get a little bit of move to the downside on Monday and it's just hanging right around 97, 197, we're not getting a more of a strong move to the downside. Well, we'd probably just get out of the trade at that point in time. And we'd be down, it looks like $55 according to the what if calculator. And that's where my risk is at. That's where I'm looking at it. Now, if I'm starting to get back this way and I get down to 195, 190, well, now you're in a good situation. And if you can even get a market move, which is possible over a few days of 7 or 8 points, well, you didn't have a lot of risk and the trade will pan out. So I like this trade in a short-term play. And one of the things that I would like to do is be able to go out further in time and have more time on this trade. So here's our lesson today about pricing is that time is money. So if I go back and I look at this trade and we change this up. So this is our official paper trade right here. We're still getting it done for a net credit of around 2 cents to the account. This is the official paper trade. But what happens if we go to the 21st? And we're going to keep the same strikes here, okay? So I'm going to delete this. And we're going to go to the 21st, and we're going to sell this one. We're at a fairly we're about where we were when we started Options Guide TV today. And then we're going to buy 2 of those. Okay, 91, 98. And then if I go back to the what if, those are the strikes that I had, 99, 97. Okay, look at the difference here. So now, by giving ourselves 7 days as opposed to doing 4 days on the trade, this same trade has a net debit of 50 cents. So instead of getting it done for a 2-cent net credit, we are now doing it for a net debit of 50 cents to the account. That means the market would have to go up at least 50 cents in order to pay or break even on the trade. Our profit and loss graph on the upside would actually be below the 0 line, is another way to say that. So it's awesome in the Russell 2000 index and some of these indexes that they do have the daily expirations and you can really craft your strategy. So because of that, I don't mind doing this 4-day trade. I don't think if I would have just looked at it and saw the June 7th expiration has a 50-cent net debit to the account, and then I also have the risk to the downside, I don't know if I'd want to put the trade on. I'm only going to do it if I can get it done for close to even or a small net credit to the account. Now, the odds of making money on this trade, or I guess of hitting the home run, are slim. But in the IWM, is that possible? Let's look at the chart. Like, is it possible for this underlying to make a 7 or 8 point move over a few days? And if you look at just recently, even like this was, let's zoom in a little bit here. So this was on the 12th, and we are now looking at the 14th. We were as high as 207. Then we obviously had 3 really weak down days. We're all the way down to 198. So we made almost a 10 point move. from the very high here over a 3-day period. Also, the same type of period. You see these type of moves to the upside and to the downside. So is a 7-point move in IWM possible? Yeah. The market moves down a little bit. Our only real scenario here where we're the most nervous is that the market comes down and just happens to sit right at 197, right at our long strike, and it just hangs there on Monday. Well, if that's the case, then according to the what if calculator, which is in theory, would be down about 50 cents on the trade. We put the trade on for, let's call it even, for zero. That's our point where we'd probably want to get out. We don't want to just hang around and let time decay kill us. And that's what would happen if it hangs right at 197, our middle strike. But we have a lot of scenarios where we're all right. Market goes up, market makes a bounce and goes up 5 or 6 points over the next few days. Oh, well, it's going to expire worthless. No big deal. Market goes down 5 or 6 points. Now we're in the money on the trade. And it's just a short-term trade based off of the fact that we're at a precipice on that chart where we're thinking IWM is either going to continue its weakness and go right through that support level or make a bounce. And then if that happens, oh, well, we'll just hang around. So that's my short trade that I'm going to watch here. And then I see here, before I get to the longer term trade where we're going to just look at a long straddle, and I'm going to toss that out there and just put it out there as an idea. Just stick it in your head because once again, I like where the chart is at in IWM. But before I get there, I have a question. I see Wayne's back into the chat box. Hey, Brian, 2 questions about historical volatility in IV on the TradeHawk software. Does HV for each expiration mean the percent the stock has moved? And is IV the percent the stock is projected to move? If we go, so what Wayne is talking about is IV and HV. So on the June 21st expiration that we're looking at right here, the historical volatility, which is actually what's happened, is trading right around 17%. The IV, which is the implied volatility, it's usually based off of the most at the money option contracts, which are right here. So this number is going to be very close to what you see here on the highlighted numbers as far as implied volatility is concerned. And that is what the marketplace is implying the volatility to be over the life of that option contract. So you are correct in the way that you stated it, Wayne, that historical has happened and implied is relative to the option. If you don't trade options, on an underlying stock, you can't calculate an implied volatility. But you can calculate a historical volatility because that's all based off of the actual stock price movement, or in this situation, the ETF price movement. So historical is based off of the underlying, implied is based off of the price of the option contracts. And usually you'll see a big difference around a major news event. We've had a lot of news events. We had the Fed meeting, we had the CPI report and all that. So in a lot of big indexes, there's usually a reversion back to the mean. So implied volatility, like you see, is trading fairly close to where historical volatility is at. And they're a little different. The TradeHawk software is highlighting that this is red, it's below, this is green, this is above. But that's simple, that's straightforward. So yes, you are correct, Wayne. All right, so we got a few more minutes here before the end of the show. Let's run out and look at a 30-day straddle. I'm going to highlight the fact that, once again, if we go back to the chart, that a 7-point move is very possible in a short time frame. Like if we even go all the way back for the month here, when was this? If I look down at the bottom here, we're talking about 520 when we kind of hit this high area all the way down to here, which is now, it's not even a full month. And there we had a 10-point movement, not to mention another 10-point movement. All right, so I want to pay $7 or $8. I see that right now the channel is about a $10 move, And if I go longer term, I just want to look at my long straddle, go out far enough where I get the time. I want time because I'm in this long straddle. But I also want to be able to see the movement. I don't want to pay $20 for the long straddle. Why? Because this thing isn't really moving $20. Even going all the way, in this current channel, that's the maximum move that we're seeing. So we're going to go out about 30 days on this trade. 26, this would be 12. Let me hit this here. Yeah, and I remember this now. So I'm gonna the 28th is 14 days away, but then we got the holiday, and I remember thinking about these here. So either July 12th, I'm gonna go out either 20 days, but let's start with the 14-day one. That means that we're probably going to want to get out in about 10 days or so. We don't want to ride it all the way to expiration. But in that scenario, the market's at 199, buying the long straddle. You're talking about I got to delete this 1 second. Boom, boom. That's all we're doing. Buying the most at the money call, buying the most at the money put. You're paying $6. We've saw many moves that were around $6 on the chart. I'm okay with that trade. I'm all right with paying $5.85. I don't think that if this starts trading for about half that, right around $3, I want to get out of the trade. Maybe I stick around until 250, but that also means that the market just has not moved. It's just sitting right at 199. The market does move. If we get a move to the upside and it starts, all of a sudden the call option, which is trading for $3 right now, is trading for $7 or $8. No problem taking it off. I love to leg out of long straddles. If I can get one option to pay for the whole straddle, don't mind doing that. Let the other option ride, especially if it happens in the short term. Then that allows you to have, for this example, we got the movement to the upside. We'd sell the call, say we get 7 or 8 for the call. Then we're just playing with the house's money, if you will, and hoping that you actually do get to move to the downside on the put side and decide when you want to sell that out. So that's where I'm at on that long straddle. Now, I don't like that the 4th of July holiday is in here, but let's see where the July 12th long straddle is at. So we got 28 days. Now we're still within the range, right? So 199, 388. We're looking at July 12th. We're buying that one at $1. We're buying this one at, let's clear it out again. I got to clear it out. So we're still at $8.39. Not bad. I'd rather pay somewhere around $7 for the trade, or 7.5, somewhere in that range. So, but we're still within a 10-point range. And once again, the chart shows that IWM in the short term can make a 10-point move in one direction. No problem, even within the current channel that it's at. So this would be my discussion. Do I want to do the 28 days or do I want to do the 14 days? And the 14-day, realize that if you do any of these trades, if I'm doing the 14-day, I'm probably out in 10 days. If I'm doing the 28 days, I'm probably out in 20 days. I have a little bit more time in that, but I'm not going to ride it all the way to the expiration and get into the last few days of huge time decay in your option contracts on a long straddle. Very speculative to do, but I don't mind this trade based off of where the IWM is at, or the Russell 2000 index, another way to say it, on that chart. All right. Well, no further comments that I see. That's it for this edition of Options Guide TV. I am going to keep a close eye on that ratio back spread. If I do close out the trade today, I will go in and actually put a tweet out about it. And if not, we're looking to Monday. I really kind of want to ride this one over the weekend. Monday's probably going to be a trade day in that trade, unless we get the 4 or 5 point movement to the downside. Then you got a little bit more play. Maybe you stick around for another day to see if the downside continues. On the way up, it's just a simple trade. You'd let things expire worthless, or you close it out for next to nothing if the market keeps going up. Thanks for coming. Follow me on x.com. Handle is at Brian Overby. We do live stream Options Guide TV on x.com. And we'll see you this Monday at 11 a.m. Eastern time for the next edition of Options Guy TV.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.